Welcome back to our intermediate financial accounting class and this special lecture on time value of money. Now, in our last segment, we didn't talk about a whole lot. We just talked about interest and what's involved with calculating an interest rate. It's not much, but I wanted to make sure you were comfortable with that key concept. It's too important to feel uncomfortable with that basic idea. Now that we've got that, though, let's talk about a few more issues with interest. And specifically, we're going to start with the idea of simple interest versus compounding. Now, simple interest means that we pay only on the principal. And it's a really simple calculation. I take the principal of the loan, whatever amount that people have given to me. I multiply that by whatever interest rate they're going to charge, and then I multiply that by the number of periods, or the amount of time I'm going to have this money. Really straightforward, not very realistic. Most companies don't charge simple interest. They charge what we call compound interest, where interest is charged not only on the principal, but also on the other interest. When this happens, it makes it a little bit more exciting with the calculation because I can't just do it in a simple equation. I have to figure out the interest each period so I can add that in so that I can calculate the interest again as we move forward. So it's a little bit more involved to get this compound interest. So let's take a look at an example. Let's assume that we're going to invest $5,000 today to help us buy a new car. So we go to the bank and they offer us a 4% interest rate on a special savings account. And we can choose from three options. Option number one is an account that pays simple interest. Option number two is if the bank compounds the interest annually. Option number three is they'll compound the interest semi-annually. And we have to decide which of these three bank accounts will we put our money in. Let's start with the simple interest account. Again, the equation here is we're going to take the principal, the amount owed or invested, times the interest rate, times the number of periods. In this case, years. So we're going to invest $5,000. The interest rate offered is 4%, and the number of periods is 5. 5,000 times 4% times 5 will give us $1,000 in interest, and I would then add that to the 5,000 in cash that I originally put in, and I would end up with $6,000 towards my new car. Now let's take a look at compounding. Compounding, again, means that I pay interest not only on that principal amount, but on all of the interest that accrues as well. So in order to do this, we're going to build a table. So we're going to put one column of the different periods. We'll calculate our interest, and then we'll get our total value over here. So at the beginning, we've had no interest, but we start with $5,000. At the end of year one, we will now have accrued 4% interest on this 5,000. So my interest rate here is 4%. So 5,000 times 4% is $200. So in that account now, I have $5,200. That's the end of year one. At the end of year two, interest is now accrued not on the 5,000, but on this 5,200. So 5,200 times 4% is $208. And I now have 5,408 in my account. Year three, same idea. 5,408 times 4%, and I'm just going to round these to the nearest dollar. 216, 56.24. Period 4, same process. And as we finish out here with year 5, 6,083. And you can see, with the compound interest, I've made much more money. On a simple $5,000 loan, almost $100 more because of compounding. Why? Because we're paying interest, or the bank is paying interest on both the money that I gave them and on the interest that they've already given me. Let's go ahead and take a look at that last option and see the effect of even more compounding. What if the bank pays us our interest every 6 months instead of just once a year? So this is semi-annual. Compounding. And we're going to set it up the same way. We'll do the period, we'll do the interest, and then we'll do the balance. And in this case, same amount to begin with. Now they're paying interest every 6 months. Now you need to know this, highlight it, circle it. It's a key concept for time value, and that is that interest rates are always annual unless they specifically say otherwise. Which means if the bank pays 4% annually every 6 months, they're going to pay 2% semi-annually. So I'm going to use 2% as my interest rate here. Period 1. 2% of 5,000 is $100. So 5,100. Now we take the 5,100 times 2%, we get 102. So 5,202. Period 3, now we're taking 2% of the 5,202, and that's going to give us 104 as our interest rate. So 5,306, and we're going to keep doing this. 4, 5, 6, 7, 8, 9, 10 6-month or semi-annual periods. I'm going to let you go ahead and finish this out, and then when you come back, we'll compare your table to mine. Now, if you remember, there's a big difference between the simple amount, that was $1,000 in interest, and annual compounding, which ended up giving us $1,083 in interest. This time, not a very big difference, still a big difference between simple and compound, but it's only about $12 difference in interest between annual and semi-annual. But then we've only got a $5,000 loan in here. If you had 5 million or 500 million or 50 million, and we're talking about a big amount from a company and quarterly versus annual, this could very easily add up to a lot of money. And because compounding can add up to so much money, we often talk about the power of time. The amount of compounding that we do greatly increases the amount of interest earned or owed, especially as the numbers get bigger. So as a borrower, we want the interest to compound as little as possible. As a lender, we want it to compound as much as possible. Best example of this difference between borrowers and lenders, we actually have ourselves in our own savings accounts and either credit cards or other payments that we're making. For example, I pay monthly on my house. We all pay monthly on our credit cards. They compound monthly. But the bank, for my savings account, only pays me once a quarter. So the bank's got money coming in both ways, right? They're saving money by not compounding our savings very often and making extra money by compounding our debts much more frequently. Because of this idea, investments usually aren't even talked about in terms of years. They're talked about in terms of periods, which is what we use in our tables. A period is the amount of time between payments. So if you have a 5-year loan that pays quarterly, you have 20 periods because you're going to be making or receiving payments 20 times over those 5 years. Now, to illustrate the value of time and the power of compounding, we come to an example that's been used for years. And the question is, would you rather have $1 million today, or I can give you a penny today and double the amount I give you every single day for the next 30 days? Which would you rather have? Now, I'm not really offering this, by the way. It's just an example. Most people would say, I'd rather have the $1 million. That's a lot of money. And a penny is just a penny. But you'd be wrong. Here's what it looks like over the first 15 days. I pay you a penny today, I pay you 2 pennies, and then 4 pennies, 8 pennies, and so on. By the end of day 15, I'm paying you $163.84 that day, and I paid you a total of $328-ish. And at this point, halfway through, most people are going, man, should have taken $1 million. But take a look at the next 15 days. By the time we get to day 28, I have paid you well over $1 million, almost triple that. And by the end of the time, you would have earned a full $10.7 million. And it all started out with a penny that doubled. Now, most interest rates don't double your money every day, but the principle, pun totally intended, is the same. If we can compound more frequently, if we can understand this and get it to work in our favor, we can make a lot of money. Let's go ahead and stop there. We've done a couple of examples. We've looked at some really cool things. When we come back, we're going to start talking about time value of money, present value, future value, and some of the more formal ways of looking at these concepts as opposed to the simple ones that we've looked at so far. I'll see you then.